Yo guys, welcome back to Stock Talk Insider. Today we'll be talking about the stock market outlook and a little bit about where we're headed, of course, like I try to do in every video. But again, I want to thank you for all of the support on the last videos. If you can do that again, leave a like if you liked the previous content. If you've never seen content of me before, of course, watch a video before you leave a like, because I literally only want you to like the video if you really appreciated the video. And if you want to take it a step closer, then you can also subscribe on the channel, or how you want to say it, subscribe to the channel. I think it is in English said like that. But yeah, going straight into all of the information I want to give you guys is, well, the first step. Welcome back to the channel first of all. So in today's video, we're diving into the key stock market takeaways for the week starting of September 8th. Well, that is for me tomorrow if I'm making this video at this time. We'll cover where the S&P 500 currently stands, as we see in front of us, the chart of the 5-year S&P 500, which stands at 6,481. We had an all-time highest close of all time, as I said. Somewhere in the past week that was around, what was it, 6,503 or something. We'll get into that in a minute, but yeah, that's what we want to see in this video. We also want to look at the most promising sectors, the latest labor market data, why the Fed may need to cut rates quickly, how AI is reshaping entry-level jobs, and which specific stocks are worth watching. So stick around until the end for a clear weekly checklist on all of the stocks we have in the portfolio. And I will also give you guys a little bit of an information about where we stand with the portfolio, where I personally want to go with the portfolio, and a little bit about that. So taking the S&P 500 chart, we'll dive a little bit straight into a more recent chart. So we had an all-time close of, what was it? I think it was a little bit around here. Yeah, it was around here. Oh, what I meant about the highest close was actually around August 28th, so actually a week ago, not this week, but this week we actually literally almost got there. So yeah, you can say that last week and this week we actually closed around 503, so 6,503, which was the highest close. It doesn't really matter about the $1, but that was the highest close of all time. As you see, since the beginning in 1800s, we are up very, very much, but that is not something we actually have to look at. It's especially a little bit of the 5-year we want to look at. So yeah. Year to date, we almost have a 10% return. I do think that if we don't get a bigger drop in September and we keep going higher to the likes of 6,600 and 6,007, 6,008, we might see the 7,000 before having a dip. But of course, we can have some little cracks in going up, but a dip like we got in March, April, that's maybe something we'll get around, well, what is it, between 6,800 and 7,000. So yeah, in 1 year time, we still also have almost 18% in profit if you invested in the S&P 500. So it's all very deep into the green, especially the last 3 years. So a bigger drop like April was already very nice to get in again, but still it's bought up very quickly. So having a new dip like that can take us some time. Maybe the dip like October 23 was one of the more bigger dips since last time. We also had a little one last year around August 5, which was a very hard one, but that was bought up very quickly and we went just straight up again the month later. So having talked about a little bit of the S&P 500, we'll go over the market overview. Well, the S&P 500 is trading around 6,481.51, just below the all-time high intraday. of last week. So momentum remains bullish, but after a strong summer rally, short-term pressure or minor corrections are possible. There's also a lot of things to talk about around rate cuts, which will lead us the way we will go in what the outcome of that may be. So the momentum remains bullish, as said before, but in other words, the trend is up, but caution. The trend is up, but caution is warranted in the near term. A little bit about its macro agenda. So what are the things that matter the most this week? Well, Thursdays, we have a very big one, I think. In my opinion, well, I think all people on the market think this is a big one. The CPI report, this is probably the last one we get before the rate cuts. If there are rate cuts, maybe they keep the rates like they are, but I do believe that they will cut rates. Also, there's like 100% chance they will cut. So yeah, for September, I think we'll have a rate cut. On Friday, we have some consumer sentiments plus weekly jobless claims, which is also a bigger trend that people are watching in the last months, because that's also a thing why people want the rates cut. These data points are crucial for the Fed September 16-17 meeting. Softer inflation reading could open the door for a rate cut, which historically benefits equities. But as I said before, I do think that we'll get a rate cut this month. A little bit of the deep dive into the labor market. So, and of course, rate cuts. The job growth nearly stalled, so August payrolls added 22,000 jobs, June revised to a net job loss. Unemployment rose 4.3%, the highest in nearly 4 years. So also going to job openings, well, that's down. Jobs openings fell to 7.18 million, lowest in 10 months. Quits rate are 2%, fewer workers switching jobs, so that's also a thing of people not sure getting another job somewhere else, so they stay, so they don't quit as fast as before. That's also a key thing. Some wage growth cooling, so people aren't getting more wage than before, like the wages of people aren't growing as fast as before. It's also a little thing. So average hourly earnings are up 0.3% month over month, which is still around 3.7% year over year. Consistent with its 2 to 2.5% inflation, wage pressure is easing. So it is still going up, but it is not as drastically going up. It's just easing a little bit. Some leading indicators are temporary help services down again, 21% drop since 2020 peak. Interest rates are still restrictive, so the Fed funds are 4.25 to 4.50%. 4.50%, PCE is 2.6%, core PCE is 2.9%, real estate is plus 1.6 to 1.9%. Conclusion is that the job growth is slowing, unemployment is rising, wage pressures easing, yet rates remain tight, which is the reason we'll probably again get the rate cut in September already. This supports the case for 1 or 2 quick rate cuts, 25 to 50 basis points, to avoid unnecessary labor market stress. And then going forward into the structural shift of AI and jobs. AI is already reshaping the lower entry-level jobs in customer service, administration, and data entry that AI easily already the day of today can take over of normal human beings going to work. AI adoption may exaggerate employment weakness even as a consumer spending holds. For the Fed, higher unemployment doesn't automatically mean higher inflation, potentially making them more comfortable cutting rates a little bit sooner. So the investor's takeaway looking at this all is that short-term pressure for rate cuts will be on the table. Long-term companies adopting AI efficiency, big tech, SaaS, automation could strengthen margins and lead the next rally up. A little bit about the sector and stock teams. So the tech AI is still driving the market. We have some energy, which has cheap value sector like Chevron, Schlumberger, Kinder Morgan. Going to gold, we have some positive sentiment as hedging, which, well, historically in September, the gold standard goes a little bit higher because of the uncertainty, because it is the baddest month of investing of the year in historical numbers. So that's normally a little bit of a normal thing to see that gold goes up in September. The watch lists are Amazon, Netflix, Shopify, and Capital One. Risks are Nvidia caution because of some Broadcom data, correction signals, or also some things. Then I have some stock spotlights, key names to watch. Especially these are all of the companies I own. I'm going a little bit broader in explanation about AMD, but further, besides AMD, I'll do some short mentioning about the other 6 stocks I own. So starting with AMD. AMD is riding the AI hardware wave with MI300 chips and growing data center adoption. That's one. Recently, Broadcom has made headlines, but there's the key. The AI data center market is huge. There's room for multiple players. So remember, Broadcom is also 5 times larger in market cap as a company than AMD, yet AMD's AI growth cycles haven't even started, in my opinion, and they still need to start adopting their growth cycles for coming years 26 and 27, and still a little bit of 28, in my opinion. Bottom line, Broadcom news doesn't limit AMD's potential. There's plenty of market share for both and even more companies. So I still believe that AMD has more upside potential as a stock. I'm not saying that the company itself will be bigger than Broadcom or Nvidia. I'm saying that its market share that AMD can take, especially with their potential, is so much bigger than the stock price for Nvidia or Broadcom going up in the next 3 years. That's what I mean. That's why I invest in AMD, because I want to earn the money. Then the next 6 stocks are the following. So starting with Amazon, I also like Amazon a lot because they are also very stable. They have a lot of cash, a lot of revenue. They'll probably be one of the they are already one of the biggest companies, but probably will be one day the biggest company on earth. Just because of what Amazon does, the business is just so good. I can't describe it in other words. It's just so good. So it's a technical buy zone approaching AWS growth plus AI integration in retail and logistics, lower rate support, consumer spending, and also again the mentioning of AWS going back into the deep plus 20% growth margins is also a very big one. e.l.f. Beauty, social first brand, resilient demand among younger consumers, even in cooling economy. And I can say you guys that in the coming years, e.l.f. Beauty, probably even faster than years, maybe in a year time, will go to the $200 mark. We're going back there. Fortinet is also one of my more defensive stocks. It's had a very big pullback, but it is still a very, very resilient and strong company. Besides that, the stock also is, because of that, very resilient and strong. Cybersecurity tailwind from AI adoption, short-term caution from IT spending slowdown. There are some things, but still, if you get the good companies in cybersecurity, where I think Fortinet is one of, then cybersecurity is just a good investment, because all of the AI news, all of those new inventions will need cybersecurity, because the world is becoming more and more online than yesterday. So every day we're becoming more and more online. That's why I invest in one of the cybersecurity best companies in my opinion. Then we have the Honest Company, one of my more speculative stocks, but not because it's a speculative stock. I don't believe in it. So I've made more videos about Honest than most of the stocks I'm talking about right now. So I do really believe in Honest. I really believe in what Carla Vernon is doing. So that's what I'm really watching. I do want to improve the position, but for now it's restructuring. It's restructuring its operation, strong niche in natural products, resilient consumer base, and it's just making its baseline very strong so they can make its growth. They also went from 4 to 6% in guidance for the growth of revenue, but that are still very small numbers in comparison where they will probably be in 3 years. So this is a more longer term because it's also a very small capital stock. They're doing almost again, what was it? They're almost doing $100 million a revenue per quarter. There are 4 quarters in a year, so that's around $400 million a year for a capital stock of over 560 million. That's very nuts to think about, actually. They're also profitable, by the way. There are not many, actually. I don't think there's any market cap of that size that's like so small, doing 100 million a quarter and are profitable. And they're not even doing their revenue growth over 6%. So that's very big. I do think that Honest at this point should be at $6, around that level. And if Honest is at $6, they're still undervalued for all of the coming years, because there comes a time when Honest says we're ready to make our growth, we're ready to make very big marketing investments, and they'll grow their 6% revenue growth to around maybe over the double digits, which would be already a very much bigger catalyst. Going to Shopify, also one of my stocks that I can just sleep at night knowing that in 10 years this stock will be 2 times higher than it is today. It's just an easy stock to buying. So almost every brand you bought something of can have a Shopify store or use Shopify products to improve their stores. SMB e-commerce growth, AI-powered marketing, its benefits from lower rates, cheaper capital for small businesses is actually a little bit where Shopify stands right now. SoFi, I'm not explaining too much about it because I already made a lot of videos in the last month about it, but its expansion from student loans to full digital banking, lower rates, more loan demand, refinancing volume. There's just so much about SoFi, why that is just a stock that also, just like Shopify, is one you just can't lose any sleep over. You can sleep and stock will just double itself in a couple of years. So that's also something where you can easily put your money in. So yeah, the updated weekly checklist is that S&P 500 is near record highs, so bullish but cautious, of course, because that also always comes to an end. CPI on Thursday, consumer sentiment on Friday, and the Fed guidance. Sector focus, tech, AI, energy, gold. Watch lists are AMD for the AI, Broadcom context. That's something I want more clear things on. Then Amazon, Shopify, e.l.f, Honest, Fortinet, and SoFi is also something I always look at. But of course, I also look at no stocks I maybe want to buy. Some risks are the Nvidia correction signals. So Nvidia is the biggest stock. Some bad news about that can really drive the whole market down with it. There's also a bigger event because one of the more popular stocks will get into the S&P 500, which is Robinhood. That's going on for September 22. So yeah, having that said, that's your full week outlook. I do think that I hope you had something about this video. I hope I got most of the interesting points coming up for coming week in one video. And which stock do you think will lead this week? Leave it all in comments. If I've said something maybe wrong, let me know in the comments. I always love to be wrong because then I can learn some things. And besides that, if you just like the video, you can also do that. Subscribe for more. Thanks for the 100 subscribers, by the way, and I'll see you guys later.